want to go over today. There's many headlines on the tax and regulatory front in general that I think are going to have large rippling effects through our industry. I want to go over some of those points. There's also a couple headlines that are just sort of hitting on some of the tax topics that are sort of persisting within our industry over the past months and years that I think will also be good to point out. And then, there's a couple other things that I've seen online in terms of tax questions that I want to address, as well as things that I'm seeing just advising clients through my firm at CryptoCPA that I think we should go over to that will offer some value to you guys. So let's get right into it here. Starting first with the headlines. Let me share my screen here with you guys, and we'll get right into this here. So it's a pretty big week when it comes to the news front here. I'm just getting these screens situated here. So the first thing that I really wanted to hit on was this headline here, and you can see this is from decrypt.co. Court finds that Dow is a person and owes $643,542 in a shutdown order. So you'll see the subheadline here: CFTC touts the wake-up call to anyone who believes they can circumvent the law by adopting a DAO structure. So this headline sort of, gives a lot of information in it in terms of what the implications are to this court ruling. Basically, you'll see first like $643,000 in the world of, FTXs and some of these larger scandals and regulatory issues we see. It's not really the largest dollar amount, but the implications to this case, I think, are very large. So basically, there's this DAO that was called Oki DAO, and what was the claims that were, the CFTC brought forth in this trial, in which they were successful in, was basically that the founders created this DAO for an invasive purpose, which was basically operating what they claimed to be an illegal trading platform without legal accountability. And basically what they said was, rather than operating these individually, they moved this into the DAO, thinking that they can circumvent the legal requirements that would be placed on them as individuals. So basically, the CFTC filed its action against the DAO in 2022, and another judge ruled that it could not go after the nebulous organization, serving notices via chat rooms and online forums. Ultimately, the agency did so, and they settled the case with a fine. So basically, them settling the case was them admitting that them operating as a DAO was not going to allow them to circumvent these laws. And what this basically leads to is that if you're operating as a DAO, and like this is the legal precedent associated with this, if you're operating as a DAO and you haven't established any type of legal entity structure, you're more or less going to be viewed as a general partnership in most scenarios. When you're viewed as a general partnership, each member of that partnership or of that DAO is going to be joint and severally liable for any legal liabilities that result of any of the business actions that DAO takes. So why is this such a huge implication? It puts anyone that's operating in any DAOs that don't have a good legal strategy behind them, it's putting them at a very large risk from a legal perspective. In addition to the legal perspective, taking this from a tax standpoint, just like structuring a DAO isn't gonna help you escape legal liabilities, it's not going to help you escape tax liabilities either. So if you're a member in the DAO and that DAO is generating income, that DAO is buying and selling cryptocurrencies, NFTs, or other digital assets that are generating capital gains, that DAO needs to be reporting that activity appropriately for tax purposes. And if in the event that they don't, it's likely this is going to get looked at as a general partnership. And then each one of those individuals that are members of the DAO can have negative tax ramifications based off of this. So that's why this case is so important. It's because it's really starting to delineate a structure for DAOs, and for these DAOs that just are currently just conducting these business activities and believing that there's no oversight and that they don't have compliance or legal requirements. It's not going to be the case, and the end result can be that these negative impacts fall on the members of the DAO. So if you're a member of a DAO, or if you are, leading a DAO or putting together one yourself, you really need to make sure that you're getting with a legal team and a tax team and making sure that you're compliant on both fronts. In most states, there's currently not legal structures in place for DAOs, but there are a couple states that are out ahead of this. That would include Tennessee, Utah, as well as Wyoming are three of them that I can think off the top of my head. So you really want to make sure as a DAO or as a member of a DAO that you have a good legal and tax plan and a good legal and tax team, because the issues with this are not going to be going anywhere soon. So let's see here. So this line, the decision should serve as a wake-up call to anyone who believes that they can circumvent the law by adopting a DAO structure, intending to insulate them from law enforcement, ultimately putting the public at risk. So there are certainly challenges with this decision and how it will stand this legal precedent. So again, we need to take this case under consideration and make sure that your legal structure for any DAOs that you've organized or that you're participating in is strong. So that was the first article. The next article that I wanted to hit on that came out this week. Sorry, what's wrong with this? There we go. New worldwide tax standards includes cryptocurrencies and CBDC. So this is from Yahoo Finance. So you'll see the first line here: the crypto industry is getting its very own tax framework. So what this article is talking about is the Organization for Economic Cooperation and Development. The acronym for that you may be more familiar with, which is OECD. They've rolled out a new tax standard for cryptocurrencies along with a set of amendments to create a common reporting standard. So basically what the OECD is trying to do is to create a common reporting standard and way for information sharing between tax agencies and tax countries. So this is just another step to creating a global framework that will reduce the probability or the occurrence of non-compliance across crypto investors and Web3 businesses. This is because, a lot of the transactions that take place with cryptocurrencies are cross borders. Not all exchanges are located in the US or in any one specific country. And having a standard that is going to require countries to collect and exchange information in a standardized format goes a long way for regulators in pushing compliance into this industry. So let's see here. So you see, it says it looks to reduce evasion that might be done through these technologies. So it's just going to create a common reporting standard. Our new international tax transparency standards aim to further strengthen efforts to tackle tax evasion in a digitized and globalized economy. So basically, it's really just about information sharing and creating a standardized way for tax information to be shared. So you'll see here that this has three main components: rules for collecting the relevant tax information such as the scope of assets and entities transacting in them, a new multilateral authority for enforcing these rules, and an electronic XML format for sharing information across authorities. So also in this report, they also went and they touched on CBDCs and some of the tax implications associated with that, because there will be tax implications with CBDCs just like other cryptocurrencies. So this is just another step that we see in cryptocurrency, the regulatory environment surrounding cryptocurrencies and surrounding digital assets is maturing, and we're going to continue to see a more robust framework that requires a greater degree of compliance for both individual investors as well as businesses. So that was that article. Then there's a couple opinion articles that came out this week across Bloomberg tax related to cryptocurrencies that I wanted to touch on that I thought were interesting. So firstly, and let me make sure that you guys are still seeing these articles. I think you are. Yes, awesome. So firstly, crypto tax collections creep up even as many investors don't pay. So this article is blocked out because I'm not logged in right now. But basically, this article, to me, it's like, I hate seeing our industry constantly in the press maligned as tax cheats and people that don't pay their taxes because, basically my whole career is to help people do the opposite of that. And every day I'm working with people that want to get into compliance, that are dealing with a high degree of complexity, regulatory uncertainty, and many times lack of clarity in the tax code. And they work very hard to get into compliance. With that being said, there's still a large portion of the industry that isn't in tax compliance, and they believe that the blockchain is anonymous and that they don't have to pay taxes, even though the blockchain isn't anonymous, it's pseudonymous and it's on an immutable ledger. So if there's a identity connected to any of your wallet addresses, either now or 10 years from now, it's going to be an issue for you. So, there is a huge issue, I guess, of non-compliance in the crypto industry that I hate to see, and that I think in the long term is going to hurt a lot of people. Now, this article here I thought was interesting because it's still, the headline's still sort of negative, crypto tax collections creep up even as many investors don't pay. But if you go on to read this article, it's talking about the fact that tax authorities are actually reporting an increased level of compliance among cryptocurrency investors and Web3 businesses, just in terms of like what they're claiming on their taxes. So basically, what the IRS and what other taxing agencies are seeing, according to this article, is a larger percentage of people starting to report this on their taxes. So to me, this article is positive in a way where it's showing some maturity in our industry, where these tax agencies aren't seeing a larger degree of compliance across different actors in our industry, which to me is positive. But you'll see with this headline, the overall tone of the article is still, hey, crypto tax collections are creeping up, even though most investors don't pay. So, we still have this negative stigma to just basically being an industry full of tax cheats that we have to slowly shake off of us to help our industry get seen from a better perspective. But it seems like we're slowly moving towards that, at least in terms of what taxing agencies are seeing with compliance across our industry. We're seeing improvement. So that's what this article was citing. You'll also see here the OECD framework to help quantify the tax gap. So they're referencing that as well. So another thing they went on to reference here is that, we may see voluntary disclosure programs across different tax agencies where they'll go to a crypto investor and basically say, hey, like, come in and claim your back taxes and we'll agree to not go after you for penalties, interest, or any criminal actions. So overall, to me, this article is positive because we're seeing a higher level of compliance across the industry, although the overall tone and perspective on the industry in general, as you can see here, is not that positive. Now, this other article, which is also from Bloomberg Tax, is taxing crypto would be the quickest way to regulate the industry. And, this one to me is very interesting. Let me try to switch this view here real quick. I think that might be better. So let me go back to this. Taxing crypto would be the quickest way to regulate the industry. So this is from Dean Baker Center of Economic Policy and Research. So firstly, crypto, from my perspective, is taxed. Um, so I don't really know why this article's headline is saying that crypto isn't taxed. It's almost trying to create a perception that there's no taxes when you trade cryptocurrencies, which just isn't the case. So Dean, his position in this opinion piece is that imposing a tax on crypto trading would help raise revenue, reduce waste in the economy, and crack down on crime. So he goes on to say that, we should tax things that we want less of. And that's the basic argument for a tax on cryptocurrency, and more specifically, the trades on cryptocurrency. He basically claims that crypto has no useful purpose and compares it basically to gambling. And as a result, he's basically saying we should dissuade people from using cryptocurrencies and from this industry gaining adoption. And he wants to put a tax on crypto trades, not a capital gains tax like we already have, not income taxes for when you're receiving it, but an additional tax on cryptocurrency. So what he says here is crypto should be viewed as just another form of gambling. A modest tax on crypto trades, 0.5%, should go a long way towards reducing trading volume and raising revenues. This is a much lower tax rate than we impose on gambling. So he wants to basically put a tax every time that you make a trade in crypto. So obviously, that would have negative implications for the industry. And it's certainly not something that I would like to see get implemented. There's already a tax implication to every time someone transacts in cryptocurrency. If you go and you take Ethereum or Bitcoin and try to go and buy a cup of coffee, that's a taxable event that you have to have a compliance burden for in terms of having to calculate your capital gains on that, and you have reporting requirements for already, and you have a tax implication associated with it. So there's already the way that crypto is taxed as property, and that each time you basically spend crypto or you trade crypto for another crypto, those are all taxable events. That already is something that should be dissuading people from spending their crypto and from doing a high volume of trades because of the compliance requirements, because of the tax implications associated with that. Now, this tax that you would just tack onto every trade, of course, would be an additional burden in terms of the taxability, and of course, it's going to create an additional compliance burden. So this whole article basically just trashed crypto, says that it's not going to revolutionize the finance in the economy. It's not a hedge for inflation, and basically, crypto industry in general is just a bunch of bad actors. There's a bunch of illegal activity going against it. That's basically what this article says, and that's the motivation behind this tax. This is just another example. We saw the DAME tax, the DAME tax on mining that was proposed for the 30% tax. There are many different groups of people that don't look fondly on cryptocurrency and are working towards creating new tax regulations to slow the adoption of cryptocurrency. So obviously I don't agree with this article. I think it's interesting. It's something that I'm keeping a watchful eye on, and something that we'll continue to watch here in the future. So then the next article I want to hit on, this was sort of bad news, and I hate to see this. Crypto tax software TaxBit lays off almost 40% of its staff. So that's a huge cut. Almost half of its workforce gets cut. TaxBit, a software company that assists crypto holders with tax compliance, has cut nearly half of its staff in an effort to re-expand in the UK and EU, the company told employees. So, that's a big layoff and a big shakeup. And, at first I thought this was just an element of the bear market, but it looks like it may just be them reorganizing their operations to target different industries where they're seeing, growth in terms of users on their platform. So, this was unfortunate. This is just another piece of tax news. 40% of the staff laid off. That's a significant portion of people within our industry that are going to be looking for new opportunities. So if you are in that group of 40% that was laid off and you're looking for new opportunities in tax, in accounting, in technology related to blockchain, comment on my post below, on this video here below. Mention briefly, what it is that you do, what skill set do you bring to the table, and maybe we can find some connections for you to find a new place to continue to be part of this industry and help us grow this industry. TaxBit is a great software, and I'm sure the people that work there are great. So, I hate seeing our industry have layoffs like this. Although, it is sort of part of the bear market, of course, especially from a tax perspective, we're sort of on a lag. So, if we're not, we're halfway through 2023, TaxBit's probably looking at the next 6 months and saying, if there's not going to be a bull run within these next 6 months, 2024 is probably going to be slower for us too, because taxes are sort of on a lag. Everyone's going to be going to TaxBit in 2024 for what took place in 2023. So if there's like a big bull run in 2024, they're probably going to see a spike in activity like late 2024 to early 2025. So, this seems somewhat of a reorganization, somewhat bear market created, a mix of declining digital asset prices throughout the year and ongoing regulatory pressure has forced the crypto industry to wind down its collective workforce over the past 12 months. And, this article goes on to say, like, we've seen this in other places such as Kraken. So, it's just some of those bear market blues that we all have to experience. But overall, through my firm, I'm seeing a lot of growth, a lot of new companies that are coming across my desk that are building amazing products and offering great services within the industry. So I think our industry overall is very healthy, and I have a very positive outlook on the coming months and the coming years. Let's see here. So what I wanted to hit on next was more of a tax topic. So I saw this post, I think I saw this last night on Reddit. Crypto tax software went bankrupt, and this sort of ties into this TaxBit conversation too. So crypto tax software went bankrupt. For 2021, I used 8+ different softwares and CoinTelly was the most intuitive software. I spent over 100+ hours. I can sympathize with that, untangling my crypto DeFi tax nightmare. I go to do my taxes for 2022, and this company has went bankrupt. Now, this sentence is important here. Luckily, I saved a CSV with all my raw information, but what do I do now? I know I need to upload all of that info again into a new software. Whatever new software company I use needs to know the cost basis for all the trades in 2022. So the reason I wanted to touch on this was for a couple reasons. Number one is that this is still a nascent industry. Even though we've seen a lot of maturity from, like the 2016 timeframe, it's still the early days for this industry. And as a result, there's a lot of great tax software companies out there, and I'm sure many of them are going to be around 5 years from now, 10 years from now, 20+ years from now. But there'll be many that aren't going to be around as well. So you always, from my perspective, want to make sure that you're never completely married to any one of these softwares, and that you're always maintaining a certain level of ownership over your data. So in the event that one of these softwares shuts down due to bankruptcy, or for whatever reason a new software comes out that you'd prefer to use due to new functionalities and you want to switch, you don't want to be captive to just one of these softwares. And in order to do that, you need to make sure that you're doing a few things. So, what this guy did here was good in terms of saving his CSV file with all the raw information. That is a great first step. So, he's not going to just be starting from scratch and putting in this 100+ hours of work all over again. Now, he still can run into an issue that he has the CSV with the raw information. I'm not sure how good that data set is that he has, if that's before he put in the time on reconciling it, this 100 hours, or after, and he has like does he have the raw trades from all the APIs from the softwares, and the 100 hours of making the manual updates to that needs to be redone? Or does he have a CSV file with the complete reconciled trade history? And, obviously the latter would be better because it's going to save him all that extra work. So, anytime you're doing your accounting, you want to make sure that you save a few things. Number one is you want a full consolidated history, like this guy did, of all of your reconciled trades. So ideally you can just take that one file, pop it into a new software, and it's going to give you the same results as the last software did. Now, if you have experience with crypto accounting, you probably know the chances of you just popping in one of these CSVs into multiple softwares and getting the same results. The likelihood of that is pretty low. So in addition to, what I would have suggested that this guy do, in addition to saving a full consolidated history of all of his trades, is saving the necessary other reports that probably was available on this accounting platform. So for his tax documentation, obviously, you need an audit trail, you need all of your income, you need all of your gain or loss transactions with all the applicable reporting standards with that. But for rollover purposes, if this guy here had his detailed ending cost basis history at the transaction level, so, if he did these calculations through the end of 2021, if he has at the detailed transaction level what he had calculated that he held at the end of 2021, and this was verified and accurate, he can take that ending cost basis data and roll that into a new software. So then your starting point is completely accurate, because from the old software, you have your accurate calculations, you have your audit trail, you have all of your supporting documentation for that, you have all of your consolidated transactions. So if in the event of an audit on 2021, you have everything that you need there. Now for 2022, you take that detailed ending cost basis data, you roll that into a new software, and all of your opening positions for 2022 should be perfectly accurate in terms of the date, source of purchase, and the associated cost basis for the fair market value on that date. So if he would have done this, it could have been just as simple as taking that ending cost basis data, uploading it to a new software, and then importing all of his trades for that year. So again, it's very important. Don't get married to any one of these softwares, and make sure that once your accounting is completed, you put together in your permanent documentation, not saved in your account on their software or anything like that, on your computer in your permanent documentation, files that have all of your trades, detailed ending cost basis, detailed gain or loss with audit trail, detailed income statement, and any other relevant reporting that's necessary. But you want to make sure that you pull this all down and that you saved all this. So I commented on this and basically asked him that. I said, did you save the full calculations for previous years with the necessary audit trails? Did you save the detailed, verified, calculated ending closing positions? If so, it's possible you can roll this data over rather than recalculating it. And this person commented, or save yourself the headache and time and money and hire a CPA, which honestly is what I would recommend. But this is something to watch out for. I've seen also people that go to CPA firms. There was this one example a couple weeks back. Someone came to my firm unhappy with their other CPA firm who had done a lot of work for them. I think they did 2017 through either 2021 or 2022, and they weren't satisfied with the results. But they paid a lot of money to get this completed. And then I start to get into this conversation with them of, all right, if we're gonna rework this, let's decide a cutoff point. Let's see what your ending cost basis data looks like, and let's see where it makes sense for us to begin, where we can guarantee accuracy, but also not rework a bunch of accounting and transactions that you've already paid to have accounted for. Now, what happened with this guy is that CPA firm didn't provide him the detailed ending cost basis data. Eventually, he did get it. He did get a summary of the ending cost basis data from them, not the detailed transaction level data. So we couldn't really roll that over if we wanted to, but it wasn't even accurate anyway because it was never verified with the client, because you always want to verify your actual holdings to your calculated holdings, and then you want to save that detailed list of all those transactions that you were holding at the end of the year, because that's your cost basis that rolls into the next year. So this guy just didn't have that data. It was never provided by his CPA firm. And then when he got it, there was just blatant discrepancies. There were, LP positions with no cost basis assigned to it. There was NFTs that didn't have the right cost basis assigned to it. There were assets that, per the client's review, were overstated or understated in the amount that was being calculated as held. So there was just a lot of discrepancies with that. So long story short, what happened with this guy is, he paid this other firm, I forget the exact amount, but it was somewhere around $20K for all those years of taxes and accounting. And because he didn't ask them for the right data, and because he didn't verify that data, he's basically left up a creek without a paddle, to where he's going to have to go back with that firm and fix this information and then get the right ending information from them, or work with our firm in terms of reworking that all for them. So it's really a bad scenario all around. So ultimately, whether you're working just in a software and managing this yourself, or you're working with a CPA, you want to make sure that you get this reporting data, because at the end of the day, you want to have all of your data, including your cumulative cost basis data, because you don't want to be held captive by a software or a CPA firm. You want to be able to go and get your accounting completed however, wherever, and whenever you want. You don't want to be stuck going back asking a CPA that you maybe have a bad relationship with to give you more information, or trying to go to a defunct software that you can't log into to pull all your trades down from. That's just a disaster waiting to happen. You could basically end up like this guy and be looking at reworking hundreds of hours of work, which obviously nobody wants to do. So those were some of the big things that I wanted to hit on today. One other thing I wanted to mention is I've launched a newsletter called the Digital Asset Digest that will be delivering news updates and updates that I'm seeing just, through my practice at Camuso CPA on a weekly basis to your inbox. The information that's covered in it will be pretty similar to what I'm doing on these live events here, but it'll be delivered directly to your inbox in a newsletter format. And it'll include some additional details and information that I don't necessarily cover on here. Maybe, it slipped my mind when I was filming this live, and I go and I add it into the newsletter, things like that. So if you are interested in signing up for that, it's called the Digital Asset Digest, and you could sign up for that on my website at CamusoCPA.com. Otherwise, if you have any questions related to anything that I've covered here, or any comments at all, comment them below, and I'd be happy to address any questions either now or on future events. Otherwise, I really appreciate you guys taking the time here with me today to go over these events. And I'll be sure to come back with next week with more updates and more insights. And thanks again for watching.